Now this is a problem where they give us a loan and they want us to amortize the loan. That is, they want us to set up an amortization table that will divide the payment between the principal portion of the payment and the interest portion of the payment. Now, when you set up an amortization table, there's some things that you have to keep track of. One is in, the time periods. Now, a loan starts when you get the money. So when Joan got the money at the bank, that's when the loan started. So the loan starts at T0. The first payment, though, comes at the end, and every payment's at the end of every time period. This is the first time period, the payment's at the end. This is the second time period, the payment's at the end, and this is the third time period, and the payment's at the end. Those are the payments on the loan. Now the payment is made up of two things, interest and principal. And as I told you earlier in the lecture now, the little formula that you see here shows you that the payment is equal to the interest plus the principal. And it's that little formula right there that we kind of roll around to separate the payment between principal and interest. The loan balance you see over there on the far right is $15,000. That's at T0. That's how much money you borrowed at the beginning of the loan, $15,000. Now the interest rate on this loan is 14%. So in Joan's case now, she began the loan owing the bank $15,000, and she used that much of the bank's money for a year before she made her first payment. So at the end of the year, the bank's going to charge her 14% interest for the year on the beginning loan balance. So 15,000 times 0.14 gets you $2,100. The difference between the payment and the interest is the principal portion of the loan. So $64.59.95 minus $2,100 is $43.59.95. And that's how much of the loan that we've paid back. So with the first payment at the end of the first year, we paid the bank $2,100 for the use of their money, and we paid back how much of that $15,000? $43.59.95. That makes the loan balance at the end of the first year, after the first payment, the difference between $15,000 minus $43.59.95, which is $10,640.05. So we start the second year of the loan owing the bank $10,640.05. We use that much of their money for a year. They're going to charge us 14% interest on that. 14% of $10,640.05 is $1489.61. The payment minus the interest gives us the principal portion, the second payment, which is $49.70.34. What's going to be the loan balance at the end of the second year? $10,640.05 minus $49.70.34. So our loan balance at the end of the second year is $56.69.71. We start the third year, the last year, owing the bank $56.69.71. We use that much of their money for a year, they're going to charge us 14% interest. 0.14 times $56.69.71 is $793.76. The difference between the payment and the interest is the principal portion of the loan. $56.69.71 minus $56.66.19 is a positive $3.52, which is the rounding error in this loan. When you get a loan, a car loan, a home loan, no matter what it is, all the payments are the same except for the last one. That's where all the rounding error is caught up. And with this loan, you make these two payments here, but this last payment would be $64.59.95 plus $3.52. And that would make the loan balance zero. And the loan's over when the loan balance goes to zero. The C part of this problem asks, why is it that the interest you pay each year goes down on this loan? Simple enough. That's because the money we're borrowing from the bank that we have outstanding that we still owe the bank, it's going down year to year also. So if the amount of money that we owe the bank goes down every year, the amount of interest that we pay goes down every year. Just as a check for you, this principal column here, this should all sum up to be $12,000. If this is a business loan, this tells you what your interest expense, your interest deduction would be each year. First year, you get $2,100 of interest deduction, and then $1,489, and then $793. But this is an amortization schedule, very common thing in business, and this is how you calculate and put together an amortization schedule.